Good morning, guys. Wanted to get on here early in the morning, 9 a.m. Eastern, and give you guys a market update. Futures are ticking away. Market is not open till 9:30, but I thought I would just jump to it here. So what you're seeing is roguemacro.substack.com put out this free post yesterday, 2 huge problems for AI. Check that out. All right, let's get into the charts. So we'll start with gold, and gold is holding strong. We talked about this line on the last live that I did here on the channel, and it did wick down below, but it closed above, and it's holding pretty strong. If we go down here to the hourly chart, we can see that price action as well, a stab below and then a rounded bottom, Adam and Eve type of formation. So that's pretty strong. So this does look like it wants to break back a little bit higher, but overall, I think that the gold move, where it might not be completely over yet, I think it's close to being over. So here is the daily, and let's take a look at the RSI. It has cooled off considerably. RSI is a momentum indicator, and you can see it was very overheated, overbought here in these places, and it has cooled down on the daily. But once we start going into longer time frames, we are still in significant overbought conditions. Now we could see something like another high, but a lower high in RSI in the momentum, and that would be a bearish divergence and would be very bearish. For the monthly, again, we're still green on the month for this candle, and we'll see where it ends up. One thing I have been saying the last couple weeks is nobody can call exactly where the top is in gold, but being so overheated on these longer time frames, I can say that we are close to a top. So thinking about that on the monthly, we still have over 11 days left. No, not 11 days. 8 days left in the month. So we could see a push back up to the top over, maybe to close this week and then next week down or something like that. But we are close in time to when the top is. So that's my analysis on gold. Let's jump into the bigger story for today. Just a real quick stream here for you guys. This is oil. And I have been bearish on oil for a very long time. I called the top back during the Russian invasion to within a few days. And I even called this oscillating nature that we saw on the way down. So if I can just get the right layout here. So the build up to the Russian invasion and then a blow off top, called it within a couple days here of the top. I was actually interviewing with another content outlet, and then on there, I said, hey, what if we're right at the top? And we just happened to be right at the top. At that time, everyone was calling for $200 a barrel oil. Kind of like today, people are calling for $200 a barrel oil. But I said we were going to come down. And during this phase, I was like, we're going to be decreasing in this sine wave and probably fall down lower. And that has happened. So this red area is long-term support, kind of turned resistance. I mean, we tried to break out of it here for a little while, and then we're back down below it. But as I said, if we go back to the daily chart, it has been making a nice U-turn. It did seem like people were starting to line up bearish finally. Everybody is trashing on the bears. Everyone's bullish on oil because they are inflationistas and they're on this inflation trade. But the fundamentals are for oil to go lower with weaker marginal demand here in the future. And we're going to read an article to discuss that in more detail as well. But if we bring up the moving averages, you can see we are right on that 50-day. So we will see where this goes. I am not saying that it cannot go up. I'm saying that you should fade any big rips. So that's the opposite of buy the dip, is fade the rip. And we got a lot of resistance to break through as we go higher. Okay, we got the 50-day, we got the 200-day. We have this long-term resistance turn support in the red area, long-term support turn resistance in the red. And then we have this long-term trend line up here, the red trend line. So there's a lot of resistance to break up higher into the 80s and 90s. Can it get to 70? Oh yeah, sure it can. But I think it's going to be a lot harder to maintain any of those levels, much harder than most people think. Okay, I wanted to take a look at a couple articles here specifically on oil. This one is from Zero Hedge. Crude prices surge after U.S. sanctions Russian oil giants. And the important part is down here. Given President Putin's refusal to end the senseless war, Treasury is sanctioning Russia's two largest oil companies that fund the Kremlin's war machine. Treasury is prepared to take further action if necessary to support President Trump's efforts to end yet another war. We encourage our allies to join us in and adhere to these sanctions. Today's actions targets Russia's two largest oil companies, Open Joint Stock Company, Rosneft Oil Company, and Lukoil, if I'm saying that right, Lukoil, which are now designated. Rosneft is a vertically integrated energy company specializing in the exploration, extraction, production, refining, transport, and sale of petroleum, natural gas, and petroleum products. Lukoil engages in the exploration, production, refining, marketing, and distribution of oil and gas in Russia and internationally. Okay, so that are the sanctions. These sanctions might be responsible for this little bit of a pop in the oil price. What's the big takeaway? I mean, they're going after the banks. They're leveraging control over like SWIFT and over the banking system. It's not good. That's not a good look because that scares people away. Already China and other places, they know the dollar doesn't work for them. They want an alternative, but there isn't an alternative right now. So I don't believe in this de-dollarization really all that much. At the margin, maybe, but there is no alternative for the dollar right now for these companies. If they try to use something different, the reason why people use one reserve currency is because of the liquidity it provides and the reduction in transaction fees. So every time that you pay in another currency, but then you might want to hold dollars to pay something else, you have that transaction fee. And so it's inefficient to transact in two different currencies for two different things. Sorry, I'm getting notifications and I'm going to mute those. All right, so that is that story. But on the other side of this, I have another article and I'm going to bring it over. Bring it up. This one is from Reuters. And the headline is OPEC production confusion should put floor under oil prices. This came out yesterday, through it a little bit. So global oil prices are signaling that the market is tipping into a protracted period of oversupply. I called this oil glut 5 years ago. All right. And now people are starting to talk about it. But the huge disparity in forecasts for OPEC's production will likely limit the sell-off. Prompt Brent oil prices traded near $61 a barrel on Tuesday, the lowest since May. But just as importantly, futures contracts for February delivery have started trading at a pronounced discount to future prices. That means the market is now in a so-called contango structure. And you'll see this down here. I think they have a chart. Contango is upward sloping instead of downward sloping. You can see this curve is from September, and this is 1 month later in October. What this really does is contango, it incentivizes putting oil into storage or not even pumping it in the first place, but putting it into storage. I can get more money if I wait until January, right? Or June or whatever of next year. And so that's what I'm going to do. I'm going to actually put it into storage and then sell it in the future versus bringing it to market right now. So that's what contango means. That is actually bullish for the price, which is another reason why we could see a little bit of a jump here in the price with the deterioration of the curve. Okay, but let's go up here and find this. So, International Energy Agency has for months warned that there will be a severe oil glut in 2025 and 2026, pointing to the ramp up in production around the world, particularly from members of the OPEC Plus alliance. In the IEA's latest report released last week, the Paris based agency forecast a surplus of 2.35 million barrels per day in 2025 and 4 million barrels per day of nearly 4% of the global demand next year. So that is a huge amount, obviously. If you have a surplus, a glut, that is going to be downward pressure on the price. But if price goes too low, you start having bankruptcies. You start having the producers actually pulling back on their production. So yes, while we might have a glut because people have locked in, they've hedged their future production for maybe the next 12 months. Once you get past that, then they are exposed to these lower prices, and that's really going to hurt them. But this is a slow-moving beast. Investors had until recently failed to price in the expected glut. That partly because OPEC analysts were in contrast to EIA forecasting fairly balanced supply and demand this year and next, but it's mostly caused OECD inventories were at relatively low levels earlier this year, while demand was holding up in the face of U.S. President Trump's trade wars. Okay, let's go down here and see what else we can find. OPEC. So the downturn feels less durable than those in the past. However, because of the uncertainty regarding OPEC's crude oil production, that's a huge blind spot as the group accounted for nearly 30% of global supply last year. The range of estimates for OPEC production has widened significantly since the start of the year, Morgan Stanley noted in a recent report covering 7 major agencies and consultancies. The range expanded to 2.5 million barrels per year in September, or around 9% of the group's production last month, after being negligible for years. So one thing, they had cut back during COVID, they cut back approximately 5 to 6 million barrels per day in their production. So they had this excess capacity. And that was one thing that made it a very easy call to say that, any big rise in oil price will lead to them bringing on this excess capacity and pushing the oil price back down. So that's why I say sell the rips. Overall, they still haven't brought all of it back on. I think they have brought about 2 of that 5 million barrels per day back online, and they're going to do more. The U.S. is continually trying to increase its supply of oil, and it has been hitting new record high production numbers. Whether that can continue over the next year, we'll see. There's also things like ANWR. They have opened up that huge oil production area in Alaska. That won't come to bear immediately, but down the road 2 to 5 years, we're going to start seeing some production come out of ANWR as well. And so, thinking on long-term timeframes, you have to bring that into consideration. All right, and I always think too about what happens if Trump does get the war to end in Ukraine. I mean, instantly, the oil price is going to crash because Russian production is going to come back online with everybody else. And so that is another uncertainty that overhangs this market. All right. So even OPEC itself appears to be unclear about its production. Kuwait's oil minister last week said the organization would appoint a top consultant to visit member states and assess their production capacity in the coming months. So they don't even know. Shadow market. The IEA supply and demand figures suggest the world will face a staggering large glut until 2027 with few historical precedents outside the imbalance created by COVID. But things might not be quite so grim. History tells us that when prices drop, contango kicks in, oil producers rein in spending, particularly companies operating in the U.S. shale basins, where new wells have to be drilled constantly to maintain or grow output. Indeed, with current U.S. oil prices around $57 a barrel, many shale drillers would already be unable to profitably drill new wells. Now, this is a controversial number. What is the price, the break-even price for these new wells? I've seen estimates at 50 and I've seen estimates at 70 very recently from people that probably should have a good understanding of this market. So it's anywhere between 50 and 70 is my opinion. Of course, drilling activity has only modestly declined this year. Moreover, major oil companies, including Chevron and Total Energies, may plan to reduce spending in the face of lower prices. Analyzing crude flows has become increasingly difficult in recent years. Western sanctions on Russia's oil industry have led to the development of a large shadow market that is often hard to track. And the lack of official data from China's stockpiling has only further complicated things. This challenge was laid bare. Okay, so what does that mean? That means you have to look at the price. The big thing is the price has all of the information in it. Yes, things can be mispriced on a short-term time frame, but in the medium term, directionally, there's not going to be a big mispricing in the oil market. It's too sophisticated, it's too dynamic. And if you want to know about the shadow market flows, then you just look at the price and you go from there. Same thing with money, okay? The reason why they don't use money supply in their inflation count like CPI and PCE is because they don't know how to count the money. It's esoteric in the shadow banking system. In repo, they cannot count the money supply with cash and cash equivalents, so they use prices. But how can we track this? How can we see into the shadows with money? And that is with interest rates. So it's kind of the same here with oil. There is a big shadow market, but we can see into that shadow market by looking at the price. Okay, let's go back to the chart here. One more look. Sitting at $60, $61.44 right now. Touch that 50-day moving average, so we'll see where this goes from here. And just a quick look at that US 10-year, and I'll show you. So as this is going down, we know that money is getting tight. As this goes up, that means people can afford to pay higher interest rates, and people are earning higher interest rates. So higher interest rates are income for somebody. They are an expense for somebody else. But as interest rates rise, that means people can afford higher interest rates and they earn higher interest rates. So money is loose versus when things start falling. That means income is going down. It means people can't afford the higher rates. And so yields are falling. Money is tight. That goes back to Milton Friedman, by the way. That is not my new analysis. All right, that's going to wrap it up for today, guys. Just a real quick, short one. I hope you guys follow, and check out roguemacro.substack.com. All right, appreciate it, guys. See you on the next one.